morning, everyone. My name is Connor McKenna.
I'm Bob Overing.
I'm Will Shepard.
And I'm Tom Placido, and here's our presentation. Early in the year, we saw a 13% rise in the stock markets in the first quarter as a response to strong employment data and increased household spending. April saw a flatline in the markets due to surprisingly low employment data.
In May, markets fell 5.5% due to continued disappointing employment data and the European debt crisis. Though some indicators may give cause for worry, analysts can be cautiously optimistic about slow growth for the foreseeable future.
Preliminary first quarter GDP for 2012 is 2.2%, which is an increase from the first quarter last year at 0.4%. Still, growth is decelerating from the fourth quarter of 2011, and overall results are mixed. For example, the rate of investment is down, but this has been substantially offset by increases in private consumption of up to 2.9%.
Consumer confidence is up, reaching a 4-year high. Retail sales are also strong. Moreover, April manufacturing reported 54.8, up from last year's average of 53.2. This could put upward pressure on firms to hire, so there is cause to be somewhat optimistic about increased GDP growth in the coming months.
Actual CPI has come down to meet core CPI at a rate of 2.3% in April because we've seen a decrease in energy prices. Reduced demand factors include fears of European recession and the slowing of China's growth. Additionally, we've seen no major supply disruptions from the Middle East. These resultant reductions in energy prices may provide a boost to production in the coming months.
One of the major events that has significantly impacted the U.S. markets in recent months is the ongoing European sovereign debt crisis. This graph illustrates long-term borrowing costs for various European nations. Rates were rising in the early part of the year due to worries about Greek debt, but the Greeks passed an austerity package February 10th, which brought rates back down again.
However, in late April and May, rates rose again due to increased rumors that the Greeks may exit the euro, in addition to general debt default. A Brexit would likely have massive implications on the world economy, because general Eurozone breakup might ensue. French and German elections, both won by parties who are not supportive of helping Greece, also put upward pressure on interest rates and the likelihood that the Greeks will exit the euro.
This graph shows euro-dollar exchange rates, U.S. Treasury bond yields, and the stock market. In April and May, rising worries about European stability depreciated the euro 5% relative to the dollar. Because of the possibility of a European breakup or recession, the dollar and U.S. Treasuries are perceived as more secure assets.
With increased European uncertainty, we've seen a lot of capital flight into the United States. And as more U.S. Treasuries are purchased, the yield on U.S. bond falls. Additionally, investors have switched from investing in the U.S. equities markets, which are more volatile, into U.S. bonds, which has contributed to the 5.5% drop in the stock markets in May.
Despite some positive indicators recently, the unemployment picture remains sluggish. Since the 2008 recession, the decline in the unemployment rate has been frustratingly slow. More significantly, the U6 rate shown in blue, which includes marginally attached and discouraged workers, has also been slow to decline, and the gap between the official rate and the U6 rate has grown. In other words, the recent decline in the unemployment rate has been due to the exit of workers from the labor force, not any fundamentally good news.
Jobless claims did decline at the start of the first quarter, and encouraging data has provided for a substantial increase in the equities markets and trends there. However, much of this might be because of the abnormally warm or mild winter this year, rather than any real job creation. So what we've seen is that a comparatively disappointing announcement of employment data has come out in April based on what we saw in the first quarter.
Again, the recovery of unemployment after this recession has been especially slow compared to previous recessions. With the burst of the housing bubble and its slow recovery, employment in the construction industry has especially suffered. Currently, it stands at 14.5%, and a year ago it was as high as 17.8%. These jobs are unlikely to return unless the housing market makes a major rebound.
But housing is unlikely to resurge until more people are employed and have a steady income to spend. This is creating a negative cycle, reinforcing a slow recovery. Because of this, we are going to recommend policies which are specifically targeting improving labor markets.
As shown by this map, employment is not evenly distributed across the nation, with California being disproportionately affected. Some economists believe that extended unemployment benefits remove the incentive for people to relocate to states where there are already jobs. Therefore, we recommend cutting the length of the unemployment benefit from 99 to 75 weeks. In addition, we recommend cutting the firm's portion of the payroll tax permanently in order to stimulate new hiring. Additionally, we recommend cutting bureaucratic red tape in the form of business licensing and other regulation to help stimulate job growth.
In terms of monetary policy, we recommend that the Fed be prepared for another round of quantitative easing if growth continues to be slow for several quarters. Inflation is not currently a major concern, and quantitative easing would help keep markets liquid and would be an expansionary force, given that Congress is unlikely to approve major fiscal action in the foreseeable future.
From a more academic perspective, we recommend that the Fed target nominal GDP rather than its current targets of low inflation and full employment. Targeting NGDP will allow the Fed to focus on one stable macroeconomic factor that has a more direct influence over the state of the economy as a whole.
In terms of the economy's impact on the election, no president since FDR has been re-elected with unemployment over 7.2%. However, the exact effect of unemployment on elections is unproven. This graph shows the change in unemployment under a president on the x-axis and his margin of victory or defeat in a re-election on the y. The correlation is only about 25%, and it would be essentially zero if we were to remove Herbert Hoover from our analysis.
Nevertheless, polling has shown that voters consider the economy to be the most important issue by far in this year's election, so its discussion is worthwhile. Now, Obama's re-election could go either way. Some credit him with a slight decrease in unemployment. However, as we showed earlier, that might be due to decrease in the size of the workforce rather than real job creation.
Based on current polling data and trends between Romney and Obama, we would conclude that if unemployment stays at current levels, Obama will likely not win re-election. However, if unemployment comes down and voters perceive that the economy is improving, Obama will likely win re-election to a second term.
So do you believe that the U.S. debt level will become a problem in the future? And what economic indicators do you think we can look at to see it as becoming a problem?
Well, we think eventually it will become a problem and the government will have to trim spending somehow, maybe through slashing various entitlement programs or defense. And for an indicator, I think debt to GDP ratio, you probably want to keep that low under 60% or so.
So your prescription for going forward is more, it's quantitative easing, right? So aren't you worried about inflationary implications of that? We've had easy money for many years now, and why don't you think that we haven't seen a rise in inflation at this point?
We think there are a variety of factors for why there's not as much inflationary concern as you might think right now, but I think one of them is there's a decrease in the velocity of money during the recession. So as you put more money into the economy, it's having less of an effect on interest rates and it's having less of an effect on inflation. So we think that's less of a concern. And we think that also during a recession, we can afford a little more inflation than we would normally want. And that's one of the reasons we want to target NGDP. It's kind of a complicated thing to explain, but we think that through targeting NGDP, when nominal GDP drops, you have more room in that target, you have more room for inflation. And then when the nominal GDP eventually increases, you have less room for inflation.
And so you would take the dual mandate of the Fed away, you would have one focus rather than managing unemployment and managing inflation, you put it on one.
It sort of wraps them both into one, yeah.
And also, with regard to the QE, we are a little worried about inflation, which is why we recommend holding off on QE for a few more quarters and only interact it if slow growth is persistent.
Okay, very good.